was a rough October for equity investors, maybe less bad if you were a corporate credit investor. Take a look at the returns in different asset classes. So total return for October, high yield was down just 1.6%. If you invested in the S&P, the total return was down by 7%. Commodities down by over 2%. So with us is Mike Swell, Goldman Sachs Asset Management, co-head of Global Fixed Income Portfolio Management. What did that tell you?
It tells us, I think, number one, that interest rates are rising, and that's one of the bigger impacts that's impacting fixed income investments. But I think secondly is that in general, particularly high yield, you've seen this kind of incredible run, and I think people are taking profits. And I don't think there's a ton of concern around credit quality. I think it's more kind of around rates and the fact that it's been a very good performing asset class.
So does that mean that it was sort of sell some winners versus actually forecasting any kind of turn in the corporate in the credit cycle?
I don't think it's forecasting at all a turn in the credit cycle. I think it's much more about taking gains. And I think secondly is it's around when rates are rising, even though U.S. fixed income investments look attractive for non-U.S. investors, they get a little scared. They don't want to take losses. And so as a result, they end up selling into weakness instead of buying into weakness initially. And then they look and do their asset allocation maybe at the end of the year and say, wow, I can actually invest in the U.S., hedge it back to my currency and actually make money. So I think that the credit market in general is pretty healthy. And I think that there's, as a result of the significant sell-off we've seen in credit, some buying opportunities.
So why is the credit market still healthy? And I ask that question because we've had abnormally low interest rates. We've had increasing leverage. I think we've got higher leverage right now in non-financial debt than we've had like historically. And normally when that happens, you have some people borrowing some money that shouldn't be borrowing some money.
So it depends which market you're looking at. So if you look at the high yield market, actually high yield leverage has come down, and actually high yield supply is it's in negative supply territory. So you're actually seeing the market shrink. Mm-hmm. And so as a result, when markets shrink, that's typically a good thing. And if you can add deleveraging with that, that's a positive. I agree with your point. There's been two areas where there's been some increase in leverage. So I think in the investment grade space, particularly first half of the year, a lot of LBO and M&A activity, a little bit increase in leverage. But you know what? It's an increase in leverage at a time when debt service is extremely easy to make. Earnings are really good, and so it's not a significant risk factor. So the investment grade market is the one that's actually seeing weakness over the course of the entire year, and we think that's an opportunity as companies, after they've done their M&A activity, they move to actually deleverage their balance sheet. The area where there are two areas where there are some concerns. I think it's the leveraged loan market, and I think it's in the private credit market. That's where, and everybody talks about the fact that banks in the U.S. or banks in Europe have not increased lending, they've not reduced standards, and that's very true. They've been regulated and they're not big in the loan business anymore. But the leveraged loan market has picked up on it, as has the private credit market. So I think if you see some cracks in the credit system, it's likely to come in those markets.
Well, fair point. You can see kind of what you're talking about. If you come inside the Bloomberg, it's leveraged loans versus high yield versus investment grade. So you can get a good sense of how much leveraged loans have outperformed, hence the risk. So where's the opportunity?
I think that the opportunity mainly is in the investment grade credit market. I think that there, are questions over the course of the next couple of years as we're late in the credit cycle. And so while high yield, there's a little bit of an opportunity because it underperformed recently. You've had a supply shock in the first half of the year in investment grade, and you've had the opposite happen in the second half of the year where actually supply has declined. Spreads are attractive, and they're attractive at a time when the margins are great, their debt service is really low, and again, the U.S. is the high yield market. And so that demand for U.S. assets where investors can hedge back to their currency and make a return, particularly in Japan and different parts of Asia and in Europe, the U.S. IG market is the best market for it. So we think as we go into year end, we're likely to see spreads tighten.
Really quickly, where in the IG market?
I would say across the board, I would say that there's opportunity particularly in the sectors where you've seen the leverage event. So a lot of the things that on the news would cause you to be concerned, the leveraging in the telecom sector, the pharma sector, those are sectors that 2 years ago, 3 years ago, we would have talked about trying to avoid. Once the leveraging event occurs, and if you're confident in that sector from an economic perspective, and you're confident in the management teams that they're going to actually deliver on the deleveraging plan, a lot of opportunity for spread tightening. So those are some sectors we find attractive, as well as financials.